Devina, come in here. What are your thoughts on what we've seen so far, and what's your sense? Beginning something here, or you think it's just a bit of a knee-jerk reaction?
Actually, the reaction, the view is not very different from what I have said on your shows over the last couple of months, which was that in the shorter term, we were expecting some sort of volatility and correction. However, a 1 to 2 year view was positive. So that was broadly what I've been saying for a while. Of course, we've been fully or partly hedged from March. But as I said, even at that time, that while some volatility was expected, it wasn't as if that I was predicting a major crash in the mainstream indices on a sustained basis. Because of that, we were never in cash, so we were always fully invested. Up until the election results, we were fully hedged, and after that, we've been partly hedged. So, that's the way to play it. To go into cash is only when you expect for sure that more or less a crash is going to happen, which is what we expected in early March 2020 before the COVID crash. But that sort of situation doesn't come that often. And in terms of the orientation, not that different from what Dinshaw said and what I have said in the past, that we had cut back very drastically on small caps for the last few quarters itself, even though we knew that in the short term it would hurt relative performance. So the under 5,000 crore companies where we normally have 14, 15, 13 in that range, sometimes 20%, we've been at 5-6% of our portfolio. So as low as that. So we've again been quite skewed towards the large caps because the small caps is, as a category, is where risk lies and where risk management is impossible because neither do stop losses work because those stocks, when they fall like a stone. Yes, there are no exits, nor can you hedge them because the only hedge available is a nifty put which doesn't move along with the small caps. So those are the, those and other frothy areas, that sudden industries that take off and where there are a lot of thematic funds being launched. Typically, you can take that as a negative indicator that whichever category in terms of small cap, large cap, etc., or industries or themes where there are a number of funds being launched, that's almost always close to the peak of that. But having said that, on a relative basis, India still looks better than most of the world for sure. And I am laughing at all the explainers of the yen carry trade because, as John Kenneth Galbraith said, that financial markets forget history and therefore the bubble pattern just repeats. So the yen trade carries on till Monday it bursts, and that has happened multiple times, right from the time it was the trigger for the Asian crisis, or one of the triggers for the Asian crisis in the late 90s, and then another almost 10 years later, 8-9 years later. So this is one more time when the yen carry trade has exploded.
So Devina, are you a believer that a recession is coming in the US? Because I think there was one more rule, that SAHM rule, which got triggered today. And it's apparently been giving, the right call since 1965. So are you a believer in that, that the US is entering into a recession, a hard landing?
It's difficult to say just now because, if you read the daily commentaries for whole of last week, again, this is like cause for some amusement for me because on Wednesday after the FOMC meeting, the markets rallied and everybody had one nice little explanation as to why that rally was justified. Then Thursday, Friday, when the markets fell again, all the commentators, all the newsletters, all the press had one nice little story about why that had to happen. So this is, as I often say, the exact same set of data and circumstances can be used to justify a market rise or a market fall. Interest rates getting cut, wow, this is great for the market. Interest rates not getting cut, that means that the economy is doing so well. So it is, therefore also the market going up is justified. So it is all, these are all explanations. And unfortunately, I would love it if that were not the case. In most macro indicators, there aren't enough data points to say that that something which has happened in the past will repeat, because there aren't enough data points for them to be statistically significant and for all other things to be equal. And the first time you're really finding a slowdown in the U.S. labor market. So whether it goes into an actual hard landing, it doesn't seem exactly on the cards just now, because the rate cuts are, I think, not that far off, and it's not as if that there is anything disastrous which has happened on the labor market. It is just that it was not so very buoyant, and now it's not so buoyant. So I'm not very negative on the U.S. economy as a whole.